Hello and welcome to our channel. The digital money market is frozen in anticipation of the launch of a crypto ETF investment vehicle that could take the industry to the next level. Consider the holy grail of the crypto industry's desire for mass adoption, and something many companies are demanding. These financial investment funds will provide full-cycle redemption of virtual assets as a legitimate asset class on par with other traditional funding options such as gold and silver. We'll explain in simple terms why this is important. Now, watch carefully so you don't miss the most important thing.
Did you know? Cryptocurrency market value exceeds $1 trillion for the first time in its 12-year history. An ETF is a type of investment fund made up of a collection of securities such as stocks, bonds, commodities, currencies, and is listed for trading on regular stock exchanges. An ETF tracks the price movement of the underlying asset. Commodity tokens, although they are merely virtual currencies, can also be part of an ETF. ETFs are somewhat identical to mutual funds, except that their shares trade on a 24-hour cycle, similar to the direct interaction with a company's stock on a stock exchange. Mutual funds, on the other hand, trade based on their price at the end of the trading day. In short, ETFs will help mainstream financial investors invest their money in bitcoins and other crypto assets without having to own or manage their cryptocurrency, which can be difficult.
There are two types of cryptocurrency ETFs. The first type is backed by physical cryptocurrencies. The investment company managing the fund buys the cryptocurrency, and ownership of the coins is represented in the form of shares. By buying shares in an ETF, investors will indirectly own cryptocurrencies. In this way, shareholders can gain access to cryptocurrencies without the associated cost and risk of direct ownership.
The second type of cryptocurrency ETF is a synthetic option that tracks cryptocurrency derivatives such as future contracts and exchange-traded cryptocurrency products. For example, many ETFs offered by the Securities and Exchange Commission track the price of Bitcoin futures contracts traded on the Chicago Mercantile Exchange. The ETF's stock price mimics the price movements of derivatives rather than the prices of actual cryptocurrencies. Consequently, the share price of these cryptocurrency ETF rises as futures contract prices rise. It decreases with a corresponding decrease. Like other derivatives, synthetic cryptocurrency ETFs carry additional risk because their transactions may not always be transparent.
For cryptocurrency enthusiasts, ETFs are the holy grail that will increase the liquidity and use of cryptocurrencies for investment purposes. Back in 2014, about 5 years after Bitcoin first began trading on the exchange, the Winklevoss twins submitted a cryptocurrency ETF proposal to the SEC. The agency rejected their application. Since then, there have been numerous applications from various investment firms seeking to profit from Bitcoin's price volatility. The SEC has recorded at least 12 applications in 2021 alone.
Although cryptocurrency ETFs have received approval in some financial jurisdictions, they have yet to receive a green signal from regulators in the United States, the most sophisticated financial market in the world. The SEC has indicated that it will not approve cryptocurrency ETFs until cryptocurrency markets demonstrate a degree of stability and security. The situation in the cryptocurrency markets has changed since the agency published the letter. Trading volumes on exchanges have increased several times. The total market capitalization of cryptocurrencies has exceeded $2 trillion. The largest cryptocurrency exchange in North America, Coinbase Global Incorporated, is now a public organization. There has also been a change of guard at the helm of the agency. Former chairman Jay Clayton was an old aide who was seen as hostile to cryptocurrencies. He was replaced in 2021 by former CFTC head Gary Gensler, who taught a course on blockchain and cryptocurrencies at the Massachusetts Institute of Technology. Gensler's appointment raised hopes for approval of a Bitcoin ETF, but he said he agreed with his predecessor's assessment and views on cryptocurrencies.
Cryptocurrency ETFs are a nascent asset class, and given the uncertainty of regulation, their market is still being defined. But they may be one of the best tools for owning cryptocurrencies. Perhaps the biggest advantage of cryptocurrency ETFs is that they provide access to cryptocurrency without the added cost of ownership. Physically, owning cryptocurrency incurs any additional costs.
Cryptocurrency ETF stocks offer access to a fast-growing asset class for a fraction of the actual cost of buying a cryptocurrency. The price of cryptocurrencies, especially bitcoins, has risen dramatically over the past couple of years. They have largely become unaffordable for the average investor. A cryptocurrency ETF is an affordable alternative for investors looking to invest in the asset class. Cryptocurrencies have been hacked numerous times since their launch, which raises big questions about the security of the nascent asset class. Securing cryptocurrencies can be a challenge for individual investors who may not be familiar with how they work. Cryptocurrency ETFs outsource security to the providers of these ETFs. More than 1,800 cryptocurrencies are available in trading markets. The infrastructure to buy and sell those tokens is not yet developed. For example, some tokens are available on certain cryptocurrency exchanges, while others are not. There are also significant costs associated with buying these tokens. Cryptocurrency ETFs allow investors to diversify without incurring costs per token.
Despite their many advantages, crypto ETFs also have their disadvantages. Cryptocurrencies have reduced dependence on centralized financial institutions such as central banks. They also provide a higher level of privacy than government-issued currencies.
Investing in a crypto ETF means allowing the custodian to hold your digital assets. This leaves crypto ETFs open to the watchful eyes of financial observers, which negates the benefits of decentralization and privacy. The convenience of crypto ETFs has to do with management fees. Because the value is usually expressed as a percentage of total shares, investments in a cryptocurrency exchange-traded fund can attract high management fees proportional to the duration of the investment. BTC, ETH, and other currencies are usually exchanged with each other on digital currency exchange. Unfortunately, crypto ETFs cannot be traded with other cryptocurrencies. In addition, crypto ETFs cannot be used to pay for goods and services, unlike the underlying crypto assets, which some merchants may already accept. A crypto ETF can contain more than one asset, including non-cryptocurrency assets, and while an ETF mimics the price movements of the underlying assets, multiple assets in a portfolio can affect tracking accuracy. In liquidity, risk sets in if an ETF fund manager sells short. When this happens, shareholders pay a price. In addition, ETFs are likely to cause a dramatic change in the price of tracked cryptocurrencies because they will be available to more investors.
Although there are no cryptocurrency ETFs in the US markets, investors can invest their money in some other cryptocurrency ETF-like products. The closest product to a cryptocurrency ETF is the Bitcoin Investment Trust. The trust is a closed-end ETF-like fund. It holds Bitcoins on behalf of investors, and its shares are traded on over-the-counter markets.
Bitcoin Investment Trust Grayscale is not an ETF. It is only open to investment firms, accredited investors, or high net worth individuals, and is not available to the general public. GBTC has a high minimum investment amount, and each purchase of its shares comes with a lock-in period for investors. As with ETFs, the fund's sponsor, Grayscale Investment Trust, charges an annual fee, but the fee, equal to 2% of the fund's asset, is much higher than most ETFs. There are also other products similar to GBTS available on the market. For example, the Bitwise Ethereum Fund and Bitwise Uniswap Fund track Ethereum and Uniswap token prices, respectively. It is important to remember that these funds have the same features as Grayscale products. They trade at a significant divergence in price from the actual token. They are only open to accredited investors and require a high minimum investment amount. Investing in companies that hold Bitcoin is another way to invest in cryptocurrencies without direct ownership. Some publicly listed companies have become Bitcoin holdings.
Thank you for watching this video. Stay tuned for more videos.